Hello everyone. Today our group will present to you about topic for dividend and dividend policy. Our team has 7 members. Is Khánh Huyền, Hồng Ngọc, Lan Hương, Trí Đức, Thu Thủy, Phạm Linh, and Minh Hiền. Our present will include 3 parts. First is about dividend, about definition, characteristic, the different type of dividend. The second part we will present about dividend policy, and the last part is about discussion question: can dividend policy bankrupt a firm? The first is about dividend, the definition of dividend. When a company's stock raise and that company make money, they will distribute dividend to shareholder as a payment for investing. So that dividend refer to a reward, cash and otherwise that a company give to its shareholder. Dividend can issue in various form such as cash payment, stock, or any other form. A company's dividend is decided by its board of directors and it requires the shareholder approve. However, it is not obligatory for a company to pay a dividend. Dividend is usually a part of profit that the company shares its shareholder. The companies will do not have to pay dividend when they make a profit. They can reinvest the company in the hope of getting even greater return. Some companies may choose to place half of their profit back into the company and distribute the other half among shareholder. So that dividend payment follow to a chronological order of event and associated date. That important to determine the shareholder who qualify the receiving the dividend payment. It will include announcement date that dividend are announced by company management on the announcement date, declaration date, and must have approved by the shareholder before they can pay. The second is dividend date. The date which the dividend eligibility expired is called ex-dividend date or simply the ex-date. For instance, if a stock has an ex-date of Monday, they will then the shareholder will buy the stock on or after that day will not qualify to get the dividend. To get the dividend as they can buy or after the dividend expired date, shareholder who own the stock on a business day prior to the ex-date that on a Friday, May 2 or earlier will receive the dividend. The third is record date. The record date is cut-off date established by the company in order to determine which shareholders are eligible to receive the dividend or distribution. And the last year payment date, the company will issue the payment of the dividend on the payment date, which is when the money get credit on a creditor's account. Since dividends are irreversible, their payment typically lead to money going out of the company's book and account of the business forever. Therefore, dividend payments impact share price, which may rise on the announcement appropriately by amounts of dividend declared and their decline by a similar amount at opening session on the ex-dividend date. The second is about characteristic. Uh, Dividends are usually a fixed amount per share. It means that the amount of money that a shareholder receives depend on how many shares of the companies they own. If a company is on the rise and it can be difficult to own multiple shares. As this result of greater dividend are not usually cash. They may also be the form of stock or property. Dividends are often paid semi-annually or annually, but may sometimes be paid at often as a quarterly or even monthly. Not all companies pay dividend, but many do as an incentive for investors. A dividend yield will tell shareholder and a potential investor how much they can expect to gain in a dividend over of the course of the year. The dividend yield will change as the value of the stock. Uh, the third is about a different type of dividend, and Hương Lan will present to you about that part.
So about the dividend type, the different type of dividend. The first one is the regular cash dividend. So the most common type of dividend as in the form of cash. And when public companies pay dividends, they usually pay regular cash dividend 4 times a year. And sometimes firm will pay regular cash dividend and an extra dividend for a special dividend. Being a cash dividend reduce corporate cash and retain earning, except in the case for liquidating dividend when paid in capital may be reduced. So when a company consistently pays regular cash dividend over a long period of time, it sends a positive signal to the financial markets, indicating that it's growing and should continue to grow and pay dividend in future. And companies tend to maintain or increase their cash dividend payment so as to build the shareholder confidence and positively impact share price. And we have a example here of the Nike company. So Nike is a mature firm that pays quarterly cash dividends. So in February 2013, 2019, the famous sportwear brand announced a quarterly cash payment of 22 cents per share on outstanding Class A and Class B common stock available on April 1st, 2019, and the company had enjoyed increased revenues in the second quarter of 10 to 14%, and net income had increased by 10% compared to the same quarter in 2018, and the dilute earning per share has increased by 13% for the same period in 2018. So this is an example of the cash payment. And so the second one is the stock dividends. So a stock dividend is not a true dividend because it's not paid in cash. And the effects of stock dividend is to increase the number of shares that each owner holds, and is commonly expressed as a percentage. So for example, a 20% stock dividend a 20% stock dividend means that the shareholder receives one new share for every 5 currently owned. So it means that every shareholder receives 20% more stock, and the total number of shares outstanding rises by 20%, and each share of stock is worth about 20% less. And the last one is the stock dividend is so there's another situation that when stock dividend of less than 20 to 25% are called small stock dividend. And this one is with 10% of stock dividend. Each stockholder receive one additional share for each 10 owned. So it's normally less than the 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 normally one. So because they only have like less than 20 to 25, so it normally a 10% of rate. And then we have the next one is the stock split. The stock splits is the same things as the stock dividend, but it is expressed as a ratio instead of a percentage. So when a split is declared, each share is split up to create additional shares. And for example, in a 3-for-1 stock split, each old share is split into 3 new shares. So we have here, and we have to be careful that stock split and stock dividend have the same impacts on the corporate and the stock and the shareholder, increasing the number of shares outstanding and reduce the value per share. And the accounting treatment is not the same, but it depends on two things. The first is whether the distribution is a stock split or a stock dividend. And the second thing is the size of the stock dividend, if it is called dividend. And all three of categories, the figures on the right are completely unaffected by the split, and the only changes are the par value per share and the number of shares outstanding because of the number of share has doubled and the par values is cut in half. And we move on to the fourth one, the stock buyback, or we can call it stock repurchase. And an alternative form of cash payout is stock purchase. Just a firm may use cash to pay dividends. It may use cash to buy back shares of its stock. And the share are held by the corporation and accounted for as the treasury stock. And we have the advantage of stock repurchase. The first one is the acquirer doesn't have to bother with the costly revaluation or retitles of individual assets. And the second thing is buyer can typically assume non-assignable license and permits without having to obtain specific consent. And the third one is buyers may also be able to avoid paying transfer tax. And the last advantage is more simple and commonly used than the assets acquisition. So we have here the example. So consider an individual receiving a dividend for $1 on each 100 shares of stock with a 15% of tax rate. That individual would pay tax of $15 on the dividend. So selling shareholders would pay lower tax if the firm repurchased $100 of existing shares. This occurs because tax are paid only on the profit from sale, and the individuals gain on the sale would be only $14 if the shares sold for $100 were originally purchased on $60. And the capital gain tax would be 15% times $40 and equals $6, a number below the tax on a dividend of $15. So we can see that the tax from repurchase is less than the tax on the dividend, even though the same 15% tax rate apply to both repurchase and the dividend. And we have the last one. Oh, no, we have the the fifth one is the dividend versus buyback. So the main difference between dividends and buyback is that dividend payment represents a definite return in the current time frame that will be taxed, and whereas a buyback represents an uncertain future return on which tax is deferred until the shares are sold. So the stockholders will be indifferent between dividends and share repurchase in a perfect capital market. And we have the next one right on the right is a dividend in kind. So a dividend in kind, sometimes referred as a distribution in kind, is a stock dividend made in additional company stock instead of cash, and which is more common. Some companies choose to distribute a portion of their earning, products or services of the firm to investor in the form of cash dividends. So that will end all types of dividend. And we also move on to the next part is the standard method. So we have to be clear that the company does not have to pay dividends when they make profit. They can reinvest in the company in the hopes of gathering even greater returns. So some company may choose to place half of their profit back to the into the company and distribute the other half among the shareholders. And also the decision to pay a dividend rests in hand of the board of direction of the cooperation, and the dividend is distributable to the shareholders of record on a specific date. So we have four kinds of date here, which Zoo have been introduced in the first part. So we will move on a little bit quick because we already know about this. And so we're gonna move on the dividend policy. So the first one is the definition. So definitely dividend policy is the policy a company uses to structure its dividend payout to shareholders. And some researchers suggest the dividend policy is irrelevant in theory because investors can sell portion of their shares or portfolio if they need funds. So this is the dividend irrelevance theory, which infers that dividend payout minimally affect a stock price. So despite the suggestion that the dividend policy irrelevant, it is income for shareholders. Company leaders are often largest shareholder and has the most to gain from the generous dividend policy. And also most companies view dividend policy as a integral part of their corporate strategy, and management must design on dividend timing and various other factors that influence dividend payment. And we also have the irrelevant of dividend policy. So dividend irrelevant theory holds the belief that dividends don't have any effect on the company's stock price. And a dividend is typically a cash payment made from the company's profit to each shareholders as a reward for investing in the company. And the dividend irrelevance theory goes on to the state that dividend can hurt a company ability to competitive in the long term, since the money would be better off reinvested in the company to generate earning. So although there's a company that have likely opted to pay dividends instead of boosting their earnings, there's a many critic of the dividend irrelevant theory who believe that dividend helps a company's stock price to rise. And we also have the policy from the homemade dividend. So the homemade dividend concept is different from the dividend policy that applied by the company. Generally, when a company reports a profit at the end of the year, it returns the value to its shareholders by distributing a portion of the reported profits as dividends. The dividend payout seeks to maximize the shareholders' stream of income. However, the company may decide not to distribute dividends in a particular year and reinvest fund into the company's operation or finance a new venture. And we have also have the dividend and the investment policy. So firms should never forgo positive NBV project to increase a dividend or to pay a dividend for the first time. So recall that one assumption underlying the dividend irrelevant argument is the investment policy of the firm is set ahead of time and is not altered by change in dividend policy. So we have here the alternative policy. Initial dividend is greater than cash flow. So we can see here another policy is for the firm to pay a dividend $11 per share immediately, which is of course a total dividend payout of $11,000. And because the available cash flow is only $10 million, so would be to issue I'm sorry. So because of the available cash flow is only $10 million and the extra 1 million must be raised in a few ways. Perhaps the simplest would be to issue $1 million of bonds or stock now at date zero and assume that stock is issued and the new stockholder will desire enough cash flow on date one to let them earn required 10% return on their date zero investment. The new stockholder will demand one million and 1,000 of the date one cash flow, leaving only 8 million and 900 to the old stockholder, and the dividends to the old stockholder will be like you can see in the box. So we can see that at the date zero they have here the $11 million, and one we have the aggregated dividend to our stockholder is $8,009,900, and also we have the dividend per share also. So the present value of the dividend per share is, therefore we have the formula here is we have 11 plus divided by we find $8.90 divided with 1.1, and because of the new stockholder are not entitled to immediate dividend, they would pay only $8.09 per share, and thus we have the new shares are issued. So we can see that value in the equation 1 and 2 are equal. This leads to the initially surprising conclusion that the change in dividend policy did not affect the value of share of stock as long as all distributable cash flow is paid out. However, on reflection, the results seem sensible. The new stockholder are parting with their money on date zero and receiving it back with appropriate return on date one. In other words, they are taking on the zero NBV in investment. And next one, we have the discussion question, which can be represented by link fact. So yeah.
Okay, so we will move to the last part, discussion question, which is, can dividend policy be replicated? We have the answer for the question. We will look back to some definition. So bankruptcy is a situation in in which a company or enterprise is in financial difficulty, suffers a loss, and is unable to pay the debt. And at the time, a court will declare the company or enterprise bankrupt. A dividend policy is concerned with financial policy regarding paying cash dividend in the present or paying an increased dividend at a later stage. We can see that a company goes bankrupt when its cash is exhausted and unable to pay debts and employee salaries. It can say that cash is the main factor leading to the bankruptcy. In addition, there are many other forms that do not affect the cash flow of enterprise. For instance, stock dividend, the firm will issue new shares, or stock split. An owner has got 3 stock splits after one split. The owner has 200% dividends. Why? Firm prefer paying cash dividends when a company has profit after tax. Moreover, the most common type of dividend is in the form of cash, so that when a firm is about to go bankrupt, it usually loses and it will not pay dividends anymore and it will not go bankrupt. So our answer for the question is that dividend policy cannot bankrupt the firm. So that is the end of our presentation today. Thank you for listening. And if you have any question, you can write to the Slack box. Thank you.
Okay, thank you for your presentation. So now it's time for the Q&A. So do you have any questions for the group number 4? So the group number 4 have presented very clearly about the definitions of dividends and several terminology related to the dividend payment. And then 2 main parts are, the first part is the impact of dividend on the bankruptcy. And the previous part, I think, I don't remember the name, but the previous student has mentioned the different kinds of payouts, such as dividend share repurchase or stock split and other kinds of dividend policy. So when you listen to all of that information, do you have any questions? Is any question arise when you prepare for this topic? And when you read this topic and you want the group number 4 answer that. So please feel free to ask questions. So while waiting the other group's question, I have 1 or 2 questions for all of you. So the first one is, please open the timeline for dividend payment. Please open the timeline for dividend payment. And explain for me the data record and the ex-dividend date. Hello, can you listen to me? Are you here? Hello?
Yes. Asking us about the ex-dividend date and the record date, right?
Yeah, I want you to open the slides, mention that timeline. I see you have a diagram showing the orders of the dividend payment. Yes, so please explain the difference between recorded and ex-dividend date. And how about the order of the 2 dates here? This is my first question. And my second question is, please tell us the difference between the stock split and stock dividend. This is my second question. Explain the difference between stock split and stock dividend.
거창하면 em ít phút để chuẩn bị câu trả lời được không?
Yeah, you have 5 minutes to prepare for that questions. And during that time, if you have any questions, other students, please type your questions on the chat box. So are you ready?
Can you hear me?
Yes, now we can hear.
First, I'll answer you the second question about the differences between stocks and stock dividend. Um, we have there is the similarity about them that the stock dividend and the stock splits, an investor will gain more stock than they had before they received the dividend or the split took place. Both stock dividend and stock split are issues based on the company's goal, and the differences is stock dividend is issues to keep earning in the company and make the company more valuable in the future. When a company is considered more valuable, stock price will rise, and the stock split it performed because the company's stock is outperforming the company's goal, because a company does not want to encourage speculative bubble that cannot be sustained by the market. It uses split to decrease the price of stock and bring it into a more acceptable price range. And that's my answer about question 2.
So what difference between the two? I'm not really clear with that answer. I can't catch it. The main difference between the two options. Luke, can you hear me?
I'm sorry, can you repeat it again?
What is the main difference between the two options?
Um,
So I think that the main difference is the purpose of them. So with the stock dividend is when the company have no cash liquidity with the company, so they have to provide the shareholder the stock dividends. But with the stock split, it's used to reduce the market price of share. So it's the difference, I think, is between them.
Yeah, that I think is correct. And if you read the textbook, they mention the other parts. It is about the size or the volume of the stock split and stock dividends. One thing is stock dividend. If the payout is not cash, it is the stock. And as I think Jacob has mentioned, it's not the true dividends because there's no cash which is paid to the shareholder. However, there are similarities between the stock split and the stock dividends is that the number of share increase. Is it right? The number of share increased. However, with the stock split, suppose you have one stock. Now it is split into 3 or 4 or at least 2 or several stocks. However, so the size, I mean the volume, the number of shares increase very much. However, with the stock dividend, it is the same, but I mean the size of the volume is much lower. For example, if with the stock dividend, it means that if you hold 5 stocks, you have the chance to receive maybe one more stock. This is the stock dividends. And normally everything is quite the same between stock split and the stock dividend, except for the volume, the size, or the number, the increase in the number of shares. So this is the first question. How about the other questions? So how about the other questions? Yeah, this one.
So the first one is the ex-dividend date. So we can see that the date on which we have the date that determines whether the stockholder is entitled to dividend payment, or anyone holding stock immediately before the date is entitled to dividend. So we the ex date